John Purdey from edgemortgages.co.nz, and I wanted to talk today about finance companies and mainly borrowing from finance companies. We've heard a lot of bad stories about people losing their money in finance companies. These are people who have invested their money into these type of companies, and there are two very distinct types of finance companies. One is the contributory funded finance company, which is where they gather funds both large and small from the general public. The other ones are privately funded finance companies. But both of these are probably not so important, because what I'm going to talk about today is actually borrowing from those finance companies. So first of all, why would you use a finance company? What sort of people would borrow from a finance company? Firstly, finance companies are short-term funders, so they will lend anywhere between 6 months to 2 years, and after that they'll expect the loan to be paid back. So as such, they often rely on what they call a takeout. So if you are, say, buying a property and you know that you're going to sell it within that period, then you would provide them with evidence of that, and they would lend you on that basis. They generally go up to no more than a maximum of 75% of the value of the property, because again, they rely very much less on the income proof and much more on the equity and the type of property that they are involved in. The benefit with them is that you often have the ability to capitalise fees and interest, which you don't have with the bank. You've got to pay interest with the banks the whole way through, but with finance companies you can actually capitalise that, so it's part of the loan up front, and you pay nothing for that period, be it 6 months to 2 years. They often work well with property traders, so for those people that are in and out of properties. Finance companies charge more because they know that they're not going to have you on their books earning interest or earning a margin of interest for that full 30 years like the banks hope they are. So they charge fees up front, and their interest rates are slightly higher than the banks. That's just how they earn their money. It's a commercial decision to be involved with them. But they can also help cleanse a deal. So where you maybe have a bad payment history with a particular lender, you can take that loan to the finance company. It can sit there for 6 months. You make sure that your payment histories are perfect with them. Then we can take it back into the mainstream, back into the cheaper trading bank environment, and from there we get you back to the cheaper type of interest rate that you enjoy when your mortgages are clean. So effectively, the risk with finance companies, obviously like banks, is that if you borrow money from them and don't pay it back, you may lose your property. But again, if you're borrowing money from them, there's less of a risk of losing your money than actually investing money with them. So look, they certainly have a place in the borrowing environment, and any good mortgage broker will have them as part of his inventory. So if you'd like to find out more or discuss a particular situation financially, please get in contact with me, John at edgemortgages.co.nz, Jon@edgemortgages.co.nz.